find the weakest of the week. Hey, I've been doing a lot of coverage of the indices, of economic data, when it's going to roll over. What I've seen now is there is still some time before the economic data rolls over, the unemployment rate starts rolling over, total non-farm payrolls roll over, the ISM index for it to cross below the 50 mark, the contracting level. I think now it's at 54. The industrial production index, want that to roll over some more. All that added up, combined with the top pattern we had in the SPX. Whoa! Yeah, that's pretty cool. Above this top pattern right here, we still have some time. So right now, when we had that first breakdown in my head, I said it's kind of early, even in December. I was thinking more of a maybe we need 8 months. I was looking at previous top patterns. Maybe we had more time. But when it unfolds, let me check it out. Let's remove that. Remove all and triangles. When it unfolds and you're really here and you have that candle, you have a declining 12-month average, you have a monthly candle close below breakdown line, below another breakdown line here. You have to go with what the chart's telling you. And the chart's telling you that you have a monthly defined breakdown line, you're below 12-month average, and pullbacks should be seen as opportunity to short, continuation short. So when you had a pullback close towards that monthly defined breakdown line, you would have had to look for a red candle on the weekly chart to see it, to start seeing turning over, hitting that support and resistance, and then you have an opportunity to get in. The first one here was wiped through in January, and then you had another chance right here, that higher up, more close to the breakdown support, turn resistance, still below declining 12-month average. And right here, that was the last line of support. And you would have waited also for a weekly candle to confirm a turnaround or a chance to get in on a low risk environment to have a continuation downtrend. Because at this stage, you still have a 12-month average that's going downwards. The price action is still below. And that's usually when people are scared. They say, I'm not going to short. Everything's turning around. But when you look at the charts, previous patterns, these opportunities, when you get a pullback close towards that 30-week moving average or that 12-month moving average, were great opportunities to enter short. We saw it back in 2000. Look at that right here, 2007. This type of pattern right here. Oh, pulling back up. Oh, no, reversal while you're below declining 12-month moving average. So that's the type of setup I've seen over and over on monthly defined tops on the indices. And I was expecting that to pan out here. But the rally, as it extended, it invalidated those moves. And right now, we're actually going back above, and you have to wait. As I always say, each time a candle is added, the chart morphs. And you have to deal with that. Let's go on the weekly. You see, we didn't have a weekly candle up here. You would have wanted to see a nice red candle starting to turn over, and especially here, right here at that lower, you want this would have been perfect short entry below declining 30-week moving average, 12-month moving average. Higher up, right here, we had a red candle here, but that was not a pretty candle. A lot of buyers coming in that wick. I would have rather seen an extenuation candle with a lower body with a close below. That would have been a better sign for me for turnaround. So that type of candle, not quite. And this then just ran through. And even here, if we have a red candle, well, we're above a 30-week moving average. It's starting to flatten out or incline. You're above the 12-month moving average. You're above monthly defined support and resistance. So all these bearish technicals have been overridden. So even if you have a red candle here, it's not the same. It's not as powerful as having it below important resistance, where it turns around, where you have the trend in your favor. We would have been making lower lower highs here, lower highs here, lower highs here. And right now, this high here, there's just one left, and that's the all-time high. As soon as if it goes back above that, then you have to look at you can't short. You're back right now. We're actually back into a stage 3. So all that wipes out. So that brings me to which one of the U.S. markets is the weakest, and that brings me to the Russell. The Russell, when I compare to the SPX, thank you, Stan. I love that the Mansfield relative strength. So first you want to focus, even here when we had that crazy dip, the Russell, remember that's the one that went 27% down while the other ones, that means it's a nicer short. Stan always wanted to make sure you were underperforming your peers, or now the SPX. And when it's red here, below the zero line, declining 30-week average, that means that's a better short, the Russell, than the SPX. And it still is today. We've seen the Russell not even coming close to making new highs, lagging the SPX. And you're seeing it here. You came close to outperforming the SPX or just coming to neutral, but no, you're going back down. So for me, the Russell, it's still above 30-week average, but it's the weakest of the bunch. Still declining 30-week moving average. Let's look at the monthly. Still below 12-month moving average, which has started to incline, but still a lot weaker than the SPX. So what's the next step? The next step is to, if we think that the Russell, so let's say we need 6 to 8 months for the economic data to roll over, doesn't mean because I think there's 6 to 8 months that the Russell is going to skyrocket here. So it could 1, 2, 3, 4, could go up, down, and never make new highs, while the SPX does make new highs. So I'm looking at the Russell as the weakest of the bunch. I don't expect it to overcome those highs, and I'm going to prepare myself to get the weakest of the bunch. Because remember, for the index, if it moves up, there's some stocks in it that are in stage 2 that are pulling it up. There's some stocks that are stage 3 or stage 1 that aren't doing anything to help it go up. And there's some stocks that are dragging it down, stage 4. Stan had the forest to tree approach, and the way he did it was the forest was the index, and then after that you drill down to the sector, the industry, and then you had all your little trees, which were the stocks inside, driving essentially the price of the index. So I'm on a mission. I'm going to hunt the weakest of the weak. I want to put everything in favor for me to have most successful trade. So I popped up all the 2,000 of Russell's index components. If it could load, wow, trading view 2,000. Let's see how it handles that. And while that loads, I'm going to look at the one of the most important changes. These are daily changes in percentage price. And that's not, if you filter by percentage change, these aren't the type of stocks that in a stage 2 that you want to see a 50% pullback in one day, 28. These are huge, huge down days. So I'm going to start going through some of them, and I already started screening a few. There's a whole bunch. Technically, I think with your brokers, you can't short. Either the share's not available, there might be some rules under $5 you're not able to short. So I'm going to try to limit myself, even if there's some great stage 4s in there, but we can't technically short them. I'm going to try to focus on shortable stocks. So you see, even if this has been going down since 2015, Kirkland, declining, 12-month average, just a big disaster. G-Den, I completely missed that one. Or Golden, I might have done a podcast on this previously. Great stage 4 on the monthly. So the weakest of the weak. So you're in an index that's vulnerable, that's not going to make new highs versus the SPX. That's going to be the first one to go down. And all these little stocks there, these small caps or medium caps, I'm not going to fight against huge companies who had huge leveraged loans, corporate bonds, using that money to finance buybacks and drive the price up. I believe that these companies have less of that arsenal in their favor, and they'll stay weaker than the big companies that are the SPX 500 that are able to manipulate of sorts their price action by doing buybacks with low interest corporate bonds. So until that whole mechanism, that bubble implodes, which could take more time than anybody could imagine, until that price action really shows, people are starting to price in all that, start pricing in the economic data that's going to get closer and closer to rolling over, the unemployment rate starting to go back upwards. Until that starts rolling over, I think I have better chances of pushing myself on the leading stage 4. Just like a lot of people are looking now for leading stage 2 stocks, and at the end of an economic cycle for that last thrust for the SPX stock, I'm going to do the inverse. I'm going to prepare myself to short the weakest of the stocks. So there's already some that are breaking down, but I'm sure I could pick up some like here. Look at that here. Just below a declining 12-month moving average. If we could close March below this line here, we could have something. I looked at it on the weekly, Stan Weinstein style. And look at that. Below declining 30-week moving average. Red, underperforming the SPX. High red volume on that down day. Close below that weekly defined support. Below the Ichimoku cloud. Had a sideways move for a while. So these are the type of candidates I'm going to be looking for. So we'll be able to position myself for over the summer, for whenever the downturn, whenever the hammer is going to hit, whether it be at the end of the summer, in August, or before. I'm going to have chosen the best of the best to short. Look at that. Minus 15, minus 13. Lots of stage 4s there. Just, it's time to get the best of the best. This was a beautiful one. ndls. Stage 4 breakdown. Never hold below the 30-week average, even if it's inclining. It's going to go back up. This is October 22nd. Down, down, sideways move going up. This would have been a great opportunity that's why you need patience. So let's say you miss the initial down, wait for that pullback, and look at that right here, that week where it started turning over, getting close to that declining 30-week average, then you're down. And I can't overstate these huge warning signs right here, even in an uptrend, red volume, huge warning signs. And I believe the Russel is going to give me better stand, less manipulated stocks to pick through, maybe less volume. So institutional buying or huge volume, sometimes it's kind of hides. There's always high volume, so it's hard to get that twice the average of the volume on stage 2 breakouts or on breakdowns. So I think I'm going to see a little bit more clarity, a little bit more better stocks, better picks with trying to be an assassin, sharpshooting stocks in that Russel. So that's it for me, guys. I'm going to be going through them. This is just the first one, giving you a clue of where my mindset is, what I'm thinking. And look at that. Look at all these disasters. Some are going to be well advanced, but some are probably going to be pulling back with the Russel that's been pulling back recently. And we'll try to hit those as they roll over and go back down, guys. All right? That's it. Thanks for watching. Ciao, guys.